The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And our Super Bowl Sunday best to you. Good morning and welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettlear along with Accunet Mortgage and Accunet Realty Advisors, owner and president Brian Wickert, and licensed millennial loan consultant wearing the cape, David Wickert. As always, you can give us a call at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number's 1-800-877-1620. So you've been doing some digging into the MLS numbers, huh, Brian?
You know, I take these different assessments every once in a while. We're going through some leadership training, and the tests always tell me I'm not good at details. I love details, and so I did. I rolled up my sleeves yesterday and this morning, and here is some shocking news. And we're going to talk about a number that we never have talked about before, but you see it in the national headlines all the time, and that's pending sales. So this is the nose count of the number of active listings that have offers on them but have not yet closed, okay? And all these numbers are coming from the Metro Multiple Listing Service, of which I'm a member through Accunet Realty Advisors. Okay, so here's the deal. For the entire MLS, so this is all counties, and it's mostly the 5 counties that, you know, we're most familiar with in the metro area. Single-family detached home sales, the good news is we had 1,241 single-family home sales in January, and that's just 41 fewer than in January of 2016, a mere 3.2% decline.
Okay.
Not bad. But here's the shocker. Are you ready? Pending home sales are down 51%.
What?
That's half. There are only 732 single-family homes with accepted offers as of the end of January versus 1,490 at the end of January. New listings were down 10% this January for single-family homes. 2,052 people did list their homes. That's 231 fewer than a year ago. Active listings, that's, you know, the ones you can shop from if you're a new home buyer. Those total 6,970. That is almost 1,700 fewer listings to shop from.
Wait. There were 1,400 homes under contract this time last year. And
1,490.
And now there's only 732.
That's right. So this means a bad February, right? Because that's your February closings.
Yeah. Well, and there still might be some that don't go through. That's just they have it under contract.
That's true. And most contracts don't close in less than 30 days. So we're kind of saying that February looks like it's going to be a digger, going to take a big digger. Okay, if we switch over to condos, condo sales total 205 units, exactly the same as last January. Whew. All right, pending condo sales are down 53%. Even a little worse than the single family. There are only 123 condos with accepted offers in the entire metro area, down from 263 at the end of January last year. New listings down 12% for condos. That's 54 fewer people listed. There were, by the way, 400 folks that did list their condos for sale. Active listings of condos stood at 1,227. That's a 26% reduction in inventory.
So this is more than the market just taking a breather.
You know, I don't know what to make about it. Remember, we did just kind of mention in passing. Last week, the National Association of Realtors announced that for December, inventory was at an all-time historical low. So economics professors David and Steve, what does this mean if you're a home seller?
List your home yesterday.
Yeah. If you've got a good home, man, you're going to get premium price.
Yep, get it on the market because there is a bona fide shortage, dearth, whatever you want to call it, of homes listed for sale. You know, that, as we mentioned last week as well, is a great reason why you got to have, if you're on the buying side, you got to be the most beautiful version of yourself. That means a rock-solid guaranteed pre-approval from your friends at Accunet Mortgage, the only one that comes with the $2,000 guarantee, because you might be competing against other offers and having our rock solid emblem and the guarantee and the statement very clearly laid out that we've not only verified your credit like those banks do, we've also taken the time to verify your income and your down payment, and you are good to go. David, you had a comment?
I did. Maybe this is my pet theory, but just does this emphasize that if your house isn't in good shape to sell, it's going to sit, and that good homes are going to go that much quicker?
I think
it's a widening of
the goods and the not so goods.
Yeah.
I think that's definitely an element. The other thing that I thought of that I couldn't prove was I wonder if with this tight market, are more people trying to sell their homes on their own for sale by owner? I didn't have any chance to try to do any research on that. I just have an anecdote of somebody that contacted me, a past customer, has somebody that's willing to buy their home, but now they're just dickering over the price, so they wanted to get a desk appraisal. All right, so there's your update. Tight housing market still probably everywhere in the country, but we just double verified that it's true in southeastern Wisconsin. When we come back, we're going to share a story that David's got of some first-time home buyers trying to decide, gee, do I buy a cheaper house that's more of a fixer-upper, or do I buy a little more expensive house that's already done? We'll have that story when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Getting you into the home of your dreams. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Billy Joel will be in Green Bay, and he'll be putting Green Bay into a Green Bay state of mind this summer. The Piano Man is coming to Lambeau Field on June 17th, and you could be there on us. Tune in to Jeff Wagner every day this week for your chance to win a pair of tickets to the show. And also go to WTMJ.com to sign up to win a pair of premium seats. Right there, WTMJ.com. It's 10:18. The Accunet Mortgage and Realty Hour. Brian Wickert, David Wickert with us, and David's got a situation where it's kind of a quandary for first-time home buyers.
Absolutely. So there are many roads to get to this answer, and Dad and I were discussing how to best present this. But ultimately, the question is, for many first-time home buyers, do I stretch as much as I can to buy as much house that kind of gets me what I want? And in this example, let's say $200,000 gets you the house that you want. Or, honey, let's buy a home for $150,000 and make some repairs or fixes or updates on our own, because then you can make it the home that you want. And I think at Accunet, there's no wrong answer. It depends on what your preference is, but let's just go through some of the numbers. Let's pretend that Grandma's given you a $25,000 gift, and that's your limited down payment. If you're buying the $150,000 house, you want to have some money left over so that you can make those repairs after you buy the house.
I'm saying I want to make $20,000 of repairs.
Perfect.
I'm going to buy this fixer-upper. It needs a lot of work. I'm going to do some of the work myself. I love HGTV and YouTube.
Absolutely.
But I think I'm going to need $20,000 to make this thing right.
Perfect. So at the $150,000, you can make a 3% down payment. That's $4,500, and have another 20 or so left over to make those repairs.
Uh-huh.
Or you can choose to purchase that $200,000 home, and let's say you put 20, because the home is already fixed or is close to what you want.
Yeah. You buy a better house.
Exactly. Then maybe you put $20,000 down, and then you got $5,000 left over. My comment to a lot of folks is there are two down payments when you buy a house. There's getting into the house, and that, which is the financial question. And the second piece, though, is all the stuff you might want to buy after you're in the house, like a snowblower or a new couch or a new mattress or whatever it might be. You got to have cash on hand in order to do that.
So in our little scenario that we're cooking up here, we wisely didn't blow all of Grandma's money. We only put $20,000 down towards the diet, but still kept $5,000 aside. And how does that payment look?
Correct. So the difference between those two payments is $180 per month.
Okay.
But I think you noted this too when we were talking this through. If you buy the less house and fix it up a little bit, and let's say you put $20,000 of repairs or updates into that $150,000 house, you are not going to get that dollar for dollar. Let's say it's 50 cents on the dollar. great, you just improved your home value maybe from 150 to 160, and ultimately the biggest question mark is having the cash on hand to do those repairs. And yes, it's great if you've got that gift from grandma, but just, me personally as David, I would rather wait for that great house to come on the market that's already got those things completed than spend 3 or 6 months after I just bought this house fixing it.
All right, so
that's just me.
All right, so the bottom line story is we can help at Accunet Mortgage put numbers around ideas that buyers have floating around in their head. Because, I think a lot of first-time home buyers think, well, yeah, I'll buy it, and then I'll borrow. I'll get somebody will make me a remodeling loan. Well, not if you just put 5% down. They won't. So it's those kind of realities. We can help flesh out your dream. Share with us the whole picture, and we will help at least put numbers to help you make a fact-based decision. All right, when we come back from this next break, we're going to talk about the dad who is buying a condo for his daughter to live in near the UWM campus. How should he best go about that? We'll have that when we come back.
Right here on the Accunet Mortgage and Realty Show. If you have a question for Brian or David, you can reach us at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620.
Find a place to call home without the headache. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, with the new president in the White House comes a new cabinet, and that includes a new secretary of the VA. What does the head of the Milwaukee Veterans Administration hope to see under new leadership? You can find out during our WTMJ Conversation show coming up at 11:07 this morning. Brian Wickert is with us. David Wickert is with us as we delve into, from the front lines of mortgage lending, some interesting scenarios and questions for folks that are looking to make that purchase.
Yep, so this is a case of a dad who wants to buy a condo for his daughter, who's a UWM student. So he wants to buy a condo, already has it under contract, it turns out. And he calls me and says, yeah, I want to put 20% down. I said, well, do you want to have your daughter on the loan? Because that would be one way to skin this cat and make the financing the best. He goes, nope, I want to keep my daughter off title, off the loan. And for sure, my number one priority is I want to own the condo in the name of a limited liability company, or LLC. And the reason is his attorney has convinced him that there are grave, perhaps unlimited, catastrophic liability risks to becoming an owner in a condo association. I'm not so sure I agree with that picture, but I wasn't going to try to be the guy's attorney, so I decided to work with him with that particular requirement. Number one, got to own this condo in the name of an LLC. So right away that knocks out Accunet and any other lender from giving the dad the kind of loan that he probably really wanted, which was a great 30-year fixed rate, because Fannie Mae, Freddie Mac, and all the banks that we sell loans to, and there are about 4 of them, none of them want to do a residential mortgage loan where the property's titled in the name of the LLC.
Right.
Because they want to make it to the human. I don't care if you're going to guarantee it. That extra layer of having in the LLC goes, you're a business loan now.
Correct.
Okay, so the best terms he can get on his business loan, because he already checked into it, and then I checked another spot, is on a 5-year balloon at 4.5%. Okay, David, you did it. Why did you a 5-year balloon?
It's because 60 months from now, he's either got to come up with the cash or refinance the loan, and who knows where rates will be in 5 years.
That's right. So a balloon loan is not an arm. On an adjustable rate mortgage, you have the loan for the whole 30 years. You just don't know what the rate's going to be in years 6, 7, 8, 9, blah, blah, blah. On a balloon, you don't even know if you got the financing because it's up to the bank to decide whether they still love you. All right. So I pointed out to him that, well, let's call him Bob, not his real name. You've kind of traded in, you've done a good job of limiting one risk by holding this in the name of an LLC, but you've now entered, which is, by the way, a small risk, right? The chances of some catastrophic, super bad thing, and I don't even know if they can come after you as an owner beyond your equity in the condo, but that was his state of mind. So that's a really small risk. You're trading that off, but inheriting a really big risk and a much more practical and likely risk of we don't know what rates are going to be 5 years from now. All right, so here's what I did next. I said, well, tell me about your primary residence. What do you got there? Oh, well, I got a 2.99 rate on my $131,000 first mortgage. It only has 9 years to go. I don't want to touch that. Who would? That's a trophy rate. Okay. Then I got a $40,000 balance on my home equity line. I took that out and made a student loan to my son, so he's making the payments on that. I said, what's the rate on that? A quarter under prime. I said, well, that's great for now, but, that's going to be going up to 4.25. Oh, yeah, that's right, because when the Fed raises rates right on that, it's going to go up. Yeah. But his houses were 525, so we got this really cool calculator at Accunet. David and I did a weighted average interest rate. I said, let's say you kept your precious 2.99 rate. Then you got this $40,000 balance at 4.25, and this new 5-year risky balloon at 4.5. Your weighted average interest rate is 3.864 on all your mortgages outstanding. Right. And Bob, Accunet Mortgage could lend you the whole shebang on your primary residence. Are you ready? At 3.5% on a new 15-year fixed with no loan costs whatsoever. And now, and by the way, as the icing on the cake, the payment on that new 15-year fixed would be the same as all the other payments on the other loans. Actually, a little lower.
That sounds like a great plan.
I will bet you $1 he does not accept my offer.
Why?
Because people are emotionally tied to things like, I don't want to give up my 2.99 rate. So I will let you know next week if he decides to do that. All right. When we come back, we're going to have a little rate roundup. Also, we have the jobs report, which should have sent rates higher. We'll let you know if they didn't. And then also Dodd-Frank reform. What is that going to mean to home buyers? All of that when we come back after the news.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ, where it's now 10:30 on this Sunday morning. We welcome in from the WTMJ 24-hour newsroom, Colleen Bolden.
Thank you, Steve. The legal fight continues.
Helping you find a place to call home. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert and David Wickert are with us. We're to the rate roundup section of the show. We'll also be looking at Friday's jobs report numbers, which came in better than expected, and what could be happening to Dodd-Frank. But we start with the rate roundup.
Yep. So at the close of business on Friday, with 25% equity and all the other right stuff, Accunet could offer, if you wanted that 3.99 on that 30-year fixed, you'd have to pay 7/8 of a point, which would come out to $2,900 in closing costs. APR is 4.08. We could get you that 3.99 still if you'd prefer regular closing costs, 4.125%. APR is 4.14.
Do you happen to have the payment difference between 3.99 and 4.125?
I
on
do.
a $200,000 loan?
I do. It is all of, wait for it, $16.
$16. Okay, there you go.
Or, as you said, Dad, on the 15-year fixed, we could offer the low rate of 3.375 with regular cost. The APR is 3.4. Or, if you're like me, I like it when someone else buys me dinner. And we could do 3.5% on the 15-year, and the APR is the same. That's no closing costs. So the jobs report on Friday was a good one. And I think, as everybody needs to remember, good economic news is bad news for mortgage rates.
Unless it's Friday.
Unless it's Friday. And it's great economic news, and the stock market went up, and rates just kind of stayed put.
Yeah.
And I think the offsetting factor of the good jobs report, so we, as a country, created 227,000 jobs, likely to be revised next month and the month thereafter.
Sure. But let's take it like it's a real number. Sure. So 227 over an expectation of only
183.
183. Okay.
Sorry, that's the average. It was, yeah, you're right.
So that was a big, overshot. I mean, that's a lot better. That's not a little bit.
But what tempered all of that was the wage growth of 3 cents
an hour.
Yeah.
Yep. So people aren't making more per hour. They're just more people working,
which is good.
As a citizen of this fine country, I will accept that.
Yes.
If you're keeping track at home, I think always the number one thing we should be paying attention to is the number of people who are actually working and bringing down a paycheck. And that number was 152 million.
That's a lot of people.
Right. We could use more.
Of course. Well, and ultimately what this means is the Fed has all the reasons that they need to fulfill their want of raising interest rates 3 times yet here in 2017. And it's at least the odds market is betting that it's all basically going to happen in the second half of the year. It is only until we get to June does the majority of expectations think that they're going to raise rates. So they're going to sit still for March and May and see that the jobs numbers keep their strength.
Right.
And not until
Okay, so
it's coming.
We were talking earlier about how the housing market is so tight and people are not listing their homes. We listed, one reason might be they're going for sale by owner and they're not going on with a real estate agent. Another thought I just had is who wants to give up their 3.5% rate that we got them last year?
Yeah.
Or 3.375 or what have you. They don't want to trade that in now for a 4.125 unless they have a really compelling reason to do so. So if you're going to buy a house, the rates at 4.125 or 4.25 are not going to hold you back. It really shifts, I think, more of our refinancing business to shorter terms, 15-year fixed rates. People continue to wake up to the fact that their home equity line of credit is an adjustable rate mortgage that just went up again in December, and it's going to go up probably 3 more times, so another 0.75% bump. So we're seeing a lot of people put those together with their existing home balances. And then another popular thing I think we could be doing more of, because home prices are going up, is helping people get rid of their PMI.
Yes.
Nobody likes paying monthly PMI. I used to work at MGIC, the nation's largest PMI company, and it is an incredibly useful and important tool, folks, because it allows you to buy a home without having a 20% down payment. So it's good stuff. But if your house has gone up in value, we had a case just recently where we're not lowering the person's rate at all, but we're helping them get rid of their $180 a month.
Wow.
This happens to be government or FHA mortgage insurance.
That's
premium.
a raise right there.
That is a big raise in somebody's budget. All right, when we come back, we're going to talk about an executive order that President Trump signed that has the real potential to mess with Fannie Mae and Freddie Mac. So when we come back, we're going to talk about what that means to all of us as home buyers and homeowners when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, regardless of who wins Super Bowl 51, there's a good chance that the buzz tomorrow will center around the TV ads, and Gene Miller will have a full recap, the good, the bad, and everything in between at 7:51 during Wisconsin's Morning News tomorrow morning on 620 WTMJ. So there's a lot of discussion in the new Trump administration about Dodd-Frank and modifications there, and maybe even some changes to Fannie and Freddie, which I know has a lot of people talking, guys.
You got it. And so just to briefly recap, Dodd-Frank was the big federal legislation that came into being in 2010, following up on the big financial crisis of 2008. That's when Fannie Mae and Freddie Mac melted down, along with some other really big Wall Street banks, because they were making dumb bets on really risky mortgages, right? They had lowered the credit standards. Fannie and Freddie had started not only guaranteeing the loans, but also buying them and holding them in portfolio.
And they didn't have the money to make good on those loans going bust.
Correct. So they dug
the
a
derivative
hole.
market.
Right.
Oh, Derivatives, The Big Short. That's a great movie. Is that the one with Stephen?
Yeah.
Yeah.
Carell.
I love that guy. Okay, so anyway, they dug a $188 billion hole.
Wait, say that again.
188 billion with a...
There's 9 zeros after that.
Yeah, that's the losses. And so all of us as taxpayers, the U.S. Treasury Department took over Fannie and Freddie back in 2008, and we've been running them as custodians ever since then. Well, guess what? They paid back the whole $188 billion, and now they're kicking out $3 billion a quarter in profit that's going right to the Treasury. So it's kind of a good thing going. But part of Dodd-Frank said, oh, you know what? Within about 7 years, which I'm tapping my watch right now, is about right now, we got to figure out a way to get rid of or substantially change Fannie Mae and Freddie Mac. So nothing's changed that much, especially in terms of the frontline consumer, because David and I in Accunet Mortgage, we can do a 3% down Fannie Mae loan.
Yeah.
Up to $424,100 now. All you got to do is be a first-time home buyer.
Yeah.
No income restrictions. You will need private mortgage insurance on it, but you can get, what's the rate on that going to be? 4.25%,
sure.
Something like that today.
Yeah.
APR because of the mortgage insurance might be 4.6 or 7, but that is a smoking good deal. So the idea, the threat within Dodd-Frank, and what is now moved back to the top of the agenda, and this is important, folks, is maybe we're not going to have the Fannie and Freddie that we're enjoying right now, that we've gotten used to over 3 decades.
The backstop.
And David, you said you found a quote. So if we strip out, so right now, Fannie and Freddie are essentially a government guarantee on 30-year fixed-rate mortgages. Why? Because we own them. So if we extract the government from this game and say, okay, who out there in the big wide world wants to put in their private capital to take on this risk of guaranteeing mortgages? What does this guy say?
So this is Chris Whalen, who's a senior managing director at the Kroll Bond Rating Agency, that just says if you were to change that, the cost of a mortgage for your average consumer would go up several points, and it would be more like 6 or 7%, because private investors are just not willing to take the risk. Without Uncle Sam standing there in the background, the global financial markets say, I want a little bit more if I'm going to give you my money.
For that 3% down.
Yeah.
So tying back in, Steve, to our conversation earlier about, David's client, who, hell, should I buy the 150 fixer-upper or the 200? I'm pounding my fist on the table now, and we got to tell all of our consultants that, hey, this is a real threat again.
Yeah.
Like, hey, rates could be a lot higher 5 or 7 years from now when you think, yeah, I'll just sell this house after I get it dollied up and I'll buy a new one. Well, what if Fannie Mae and Freddie Mac look nothing like they do now?
Correct.
And with no other change in interest rate market conditions, the fact that we took Fannie and Freddie, the government, out of their guarantee system, now rates are 6, 7. Wow.
I remember paying a 9.5% rate and going, wow, this is pretty good.
Well, yeah, when you're coming down from
back
15.
in 1990.
Yeah. But you just think about how that would feel now coming off of this long
what would it do to
streak.
overall home prices? It would push them
make
down,
them plummet.
wouldn't it?
Yeah,
absolutely.
Because you can't swing as much house.
That's right.
Exactly.
So that's a big issue. All right. So when we come back from this last break in the show, we're going to talk about helping people in retirement buy a home. They don't have a paycheck anymore. They've got the ultimate unemployment plan. They voluntarily decided not to work anymore. How can we help them finance a home when we come back?
And if you have a question for Brian or David, you can reach us at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620.
Home buying advice from the guys who know it best. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And David Wickert as well, as we jump into the segment that focuses in on, okay, you want to buy a home, but you're retired, so you really have no income, so to speak, from a job, but you do have maybe retirement pension income, right?
Well, and David just reminded me while we were on that break, the first thing we should talk about is timing, because that is a really important point. If you are still working and you are retiring in 3 months, and that's really difficult, because we're going to ask you in the interview process, and any good bank or mortgage originator should, hey, have you announced your plans to retire?
Yeah, I told them that I'm leaving on May 1st. Why?
Because then we can't use the income from your job anymore.
Part of good mortgage lending is we have to point at the income and say, hey, that's the money I'm going to use to pay back the mortgage on a monthly basis.
And then what instantly happens, only because it's purely logical, is the person says, yeah, but I'm going to start getting my pension, let's pick on June 1st. And I've got the paperwork that says I'm going to be getting, $4,000 a month on June 1st. Well, guess what? Until you start receiving it, we cannot use it.
Yeah.
All right, so there is a timing element here of where are you in the retirement process. And then we're going to ask you again at closing, by the way, and we're going to ask your employer, has Bob announced his retirement or, indicated he's going to quit? And we've had that happen literally the day before closing. The guy was the president of the company. I'll never forget it, which is why we started asking the question at closing. We
Yeah,
called
he's
the
leaving next
employer.
week. Why?
Yeah, we just had his retirement party. It's like, stop the closing. Okay. So let's say you now have successfully retired.
Yay.
Yes, pension income is a perfectly usable source of income,
Yep.
as is Social Security and IRA distributions.
Yep.
So it's a matter of masterfully architecting those three elements because David has a situation going on right now for a home buyer where she has not yet started to take her IRA withdrawals. Go ahead and pick up on that.
Yes. So we're pairing that with some pension income as well. And what we did is we've timed it out. She, along with her financial advisor, completed the paperwork so that she would receive the first distribution from her IRA here on February 1st. And she is closing on February 24th.
Okay, so we can magically use that IRA income, even though she doesn't have a history of taking it.
Yep.
We had to prove that she had enough money in the IRA account to last at least 3 years.
Yes.
At this pace of withdrawal. Let's just say it's $3,000 a month.
Mm-hmm.
So we have to prove that she's got enough in there to last for 3 years. Does she have to keep taking it out for the full 3 years, Dave?
She does not.
Ah, okay. So she could choose to turn that off if she wants to after closing. Another situation I had was where we were going to have a son who is working co-sign with his elderly mother. So the mom lives in the condo. We were going to have the son co-sign because we thought we needed his income. Turns out he brought more debt to this party than income.
Oh.
So we were able to go back and relook at his 85-year-old mother's financial situation. If the person does not pay income tax on their Social Security or pension, we can goose it up by 25%. So $1,000 a month turns into $1,250 for qualifying purposes.
Wow.
Isn't that magical? And so we'll be closing on her refinance and saving her $140 a month on her very modest fixed income. And then the last thing we can do for people in retirement, which is really cool, is let's say you're sitting on $1 million of non-retirement assets. We have this happen to people. They just sold their company. Hey, I got $1 million, but I'm too young to take Social Security and what have you. We can do a formula where we give those assets a haircut for precautionary purposes. So we give the 40% haircut, so that turns $1 million into $600,000, and then we divide it by 60 months, and we come up with theoretical income then of $10,000 a month. Huh. So you don't have to withdraw any of the money. We can just look at that pile of money and say, you know what, that $1 million is like you making $10,000 a month of income. We'll use that to qualify you for your mortgage in retirement. That is a huge help to a lot of people.
Well, and I think you wrote a new ad on Friday talking about helping people line up the mortgage side of things as they glide into retirement as well, because as much as financial advisors talk about the asset side of the balance sheet, talking about the liability side of the balance sheet as you glide into retirement is important as well. And whether it's that 15-year or how do I pay this faster so that I arrive at retirement with something I can afford or with a house paid off, that's a conversation we're always willing to have.
Absolutely. We're here. We're your mortgage pastors on Sunday mornings. That's right. We're here to counsel you on all your mortgage and home buying needs. Okay, so to kind of wrap up what we talked about on this show, inventory is tight. Tight. So if you've got a property you've been thinking about listing, get her on the market.
Yeah.
But, if you get it dialed up, that'll really make it sell fast. Those are flying off the shelf.
We keep doing pre-approvals.
We are writing a lot of pre-approvals for people.
Yeah.
So that on the buy side, you really need one of our guaranteed, rock-solid, fully verified pre-approvals to make sure you're the best, prettiest-looking version of you when you're out there competing against other offers. Rates are still good, but kind of the big macro news is maybe the Trump administration is going to take a hard look at Fannie and Freddie, and that would be a big game changer at some point down the road. So now's the time to go ahead and click on that blue button at Accunet.com. You can get started with a rock-solid pre-approval or a no Social Security number required refi checkup at ACCUNET.com. See you next week, Steve.
You've been listening to the Accunet Mortgage and Realty Show on 620 WTMJ. Colleen Boland will join us next from the WTMJ 24-hour newsroom.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.